Welcome to InvestEdge. If you think you understand the silver market, you might want to think again, because what you're about to hear today could completely change how you view silver and its role in your portfolio. Most people believe silver is just another metal, a commodity that moves up and down like everything else, predictable and stable. But what if we're entering a final phase? A phase that could dismantle the paper silver market completely. A phase so extreme, it may make the famous 1980 silver crash look like a minor footnote in history. Right now, we are approaching what I call the silver end game. And when it begins, the spot price you see on your screen will matter far less than one critical thing: physical availability. Think about it. In 1980, two billionaires, the Hunt brothers, tried to corner the silver market. They failed. The system was powerful enough to shut them down. But today, the situation is completely different. It's not two individuals trying to manipulate the price. It's a global movement. Millions of everyday investors, large institutions, and massive industrial buyers are all competing for a rapidly shrinking supply of physical silver. And this time, there simply might not be enough to go around. Before we go any further, make sure you subscribe to InvestEdge. We publish in-depth market analysis, risk breakdowns, and long-term investment strategies designed to keep you informed, not misled by mainstream headlines. If you want to stay ahead of major market shifts like this, hit that subscribe button and turn on notifications. You won't want to miss what's coming next. All right, let's break this down. First, we'll dive into what the silver end game actually means for the market structure. Then, I'll explain why comparing today's situation to the 1980 squeeze is fundamentally misleading and why this time is different. Finally, we'll explore how physical shortages are already rewriting the rules of the entire pricing system, decoupling the paper price from the real-world value of metal in your hand. This isn't just about price charts. It's about a fundamental shift in supply and demand that could catch millions by surprise. Let's begin. What I'm about to tell you is going to sound crazy at first. There's a fifth stage coming in the silver market that nobody is talking about. Not the analysts on TV, not the billion-dollar fund managers, not even the old-timers who lived through 1980, when silver hit $50 an ounce, and then crashed so hard it took 40 years to recover. They all think they know the silver story, but they're missing the final, most explosive chapter. And here is why you should care. We've already gone through stages 1 through 4. Right now, as we speak, we're sitting in the quiet before the storm, the gap between stage 4 and the coming stage 5. If history is any guide, and it usually is, stage 5 is going to make the infamous Hunt brothers squeeze look like a casual warm-up act. But before I pull back the curtain and show you what stage 5 looks like, and why I believe it basically inevitable, you need to understand something absolutely crucial. Silver is not just a shiny metal for jewelry or silverware. It's not just a smaller, less important version of gold. Silver is the most manipulated, most misunderstood, and potentially the most explosive commodity on the entire planet. The unique combination of factors we're seeing right now has never existed before in human history. The game has fundamentally changed. So, let me walk you through the 4 stages we've already completed. Because if you don't understand how we got here, how the pieces have been falling into place for decades, you won't be able to grasp the sheer magnitude of what's coming next. You won't believe it. Let's start with stage 1. This is the Industrial Revolution phase. For over a century, silver was primarily viewed through an industrial lens. Think about it. Photography. Every single photograph taken for decades used silver halide. Millions of ounces were consumed and never recovered. Then came electronics, solar panels, medical devices, electric vehicles. Silver is the most conductive metal on Earth. It's an indispensable, non-substitutable ingredient in modern technology. For the longest time, this industrial demand was the main driver. The price was relatively stable, dictated by industrial supply and demand. It was boring, predictable. That was Stage 1, silver, the industrial metal. Then we entered Stage 2, the monetary awakening. This started subtly. People began waking up to the fact that their paper money, their dollars, euros, and yen were constantly losing value. Central banks were printing money like there was no tomorrow. Slowly, a growing number of people started seeking a safe haven, something real to protect their wealth. They rediscovered the historical role of gold and silver as real money. This wasn't a mainstream movement yet, just the smart money, the contrarians. They began quietly accumulating physical silver, not as an industrial commodity, but as a store of value. This created a new layer of demand on top of the industrial consumption. This was the quiet accumulation phase. Stage 2. Silver, the monetary hedge. This leads us directly into Stage 3, the paper versus physical disconnect. This is where things get really interesting and where the manipulation becomes obvious. As more people wanted physical silver, a massive paper market was built on top of it. Futures contracts, ETFs, derivatives. Wall Street created ways for people to invest in silver without ever touching a single ounce. The problem is, for every 1 ounce of real, physical silver that exists in a vault, there might be hundreds of paper claims to that same ounce. It's a giant game of musical chairs. For years, this system worked because very few people ever asked for delivery of the physical metal. This paper market suppressed the price. Anytime the price started to rise, big players could dump a flood of paper contracts onto the market and smash it back down. Stage 3 was this fragile illusion, the battle between a growing demand for real metal and a mountain of paper promises. And that brings us to where we are now, just exiting Stage 4, the supply shock. This is the part that even the mainstream is starting to notice, even if they don't understand the implications. The decades of artificially low prices thanks to the paper market had a predictable effect. It disincentivized mining. Why spend billions to dig silver out of the ground if the price is constantly being suppressed? So investment in new mines dried up. Existing mines are getting older, the grades of ore are declining. It's getting harder and more expensive to produce every single ounce. At the same time, industrial demand, especially for green energy technology like solar panels and electric vehicles, is going parabolic. Governments around the world are mandating this transition. We're now in a situation where industrial demand alone is on track to consume more than the annual global mine supply. We are in a structural deficit. This isn't speculation, it's just math. The world needs more silver than it is digging out of the ground. This is Stage 4. So here we are. We've seen silver's journey from a simple industrial metal to a monetary hedge. We've witnessed the creation of a massive manipulative paper market, and now we're living through a fundamental supply shock where demand is outstripping new production. Each stage has built upon the last, tightening the spring coiled underneath the silver price. This sets the scene for the grand finale. Stage 5, the Great Reckoning. What happens when the music stops in that game of musical chairs I mentioned? What happens when a critical mass of investors, institutions, or even nations decides they don't want the paper promise anymore? They want the real thing. They want physical delivery. This isn't about a few small investors buying coins. I'm talking about a systemic, global dash for physical metal. Think about the industrial users first. Companies like Tesla, Apple, and the big solar manufacturers. They can't build their products with paper silver. They need the real metal. As they see stockpiles dwindling and the deficit growing, what will they do? They will start hoarding. They'll bypass the paper markets and go straight to the sources, trying to lock in long-term physical supply contracts at any price. For them, the price of silver is a small fraction of their total product cost. Paying double or even 10 times the current price for silver is better than shutting down their entire production line. Their demand is inelastic. This industrial panic buying will be the first major trigger. Simultaneously, you'll have the investment world. As the price starts to move, driven by the real physical shortage, the paper players will get scared. Those who are short silver, betting the price will go down, will face catastrophic losses. They will be forced to buy back their positions at any price, creating a historic short squeeze. Remember the GameStop saga? Imagine that, but on the scale of a global commodity market that underpins our entire technological infrastructure. This is when the paper market breaks. The exchanges, like the COMEX, will be forced to admit they don't have the metal to deliver on their contracts. They might declare force majeure, settle contracts in cash, or change the rules. But the moment they do that, the illusion is shattered forever. The official paper price of silver will become meaningless. The only price that will matter is the price you have to pay to get your hands on a real physical ounce of silver. And that price will be determined not by a computer algorithm, but by a desperate buyer meeting a reluctant seller. At this point, the public, who has been watching from the sidelines, will finally stampede in. This is the FOMO, fear of missing out, phase on steroids. Everyone who ever thought about buying silver will try to buy it all at once. But by then, it will be too late. The dealers will be sold out. The mints will have months-long backlogs. The available supply will have already been soaked up by the industries and the smart money. This is stage 5. It's not a prediction of a 10% or 20% price increase. It's a fundamental repricing event, a reset. It's the moment when a century of suppression and manipulation unwinds violently and suddenly. It's the point where silver is no longer priced as an industrial metal with a paper derivative market on top, but is revalued as the critical strategic element it has become, essential for both our technological future and as one of the last remaining forms of real money. We are standing at the precipice of this event right now. The industrial deficit is here. The paper games are more stretched than ever. The setup is complete. Stage 5 is not a matter of if, but when. The fuse has been lit. The only question left is how long it is. If you found this breakdown insightful, imagine what else you might be missing. Let's rewind the clock to 1999. Can you imagine a world where you could buy an ounce of pure silver for just $5? $5. That's less than what most people spend on their morning coffee today. Back then, nobody wanted it. Silver was seen as a relic, a dead asset. Gold was dead too. Mining companies were going bankrupt left and right. It seemed like the entire precious metal sector was on life support, and nobody even cared enough to pull the plug. Everyone just thought, yeah, $5 silver, that's normal. But then something subtle shifted, something that almost no one noticed at the time. Central banks, which had been aggressively selling their gold reserves for nearly 20 years, suddenly stopped. The final glaring signal came from the Bank of England. They sold half of their nation's gold at around $275 an ounce. This wasn't just a bad trade. It was arguably one of the worst financial decisions in modern history, executed at the absolute bottom of the market. For the few who were paying attention, that was the bell ringing. That was the signal that the bottom was in. And so, the first stage of this modern silver story began. After that, silver started to creep up, slowly, almost silently. From $5, it climbed to $6, then $7, then $8. Did anyone care? Nope. Did the mainstream financial media notice? Not a chance. They were all chasing the dot-com bubble. But while everyone was distracted, the smart money, the deep-pocketed investors who see the world differently, they started accumulating. They were quietly buying, building their positions ounce by ounce. By 2003, silver was hovering around $5.50, still incredibly cheap, still completely ignored by the masses. But the foundation for the next explosive move had been meticulously laid. Then came stage 2. The year was 2008, and the world was about to change forever. The global financial crisis hit like a tidal wave. We saw legendary Wall Street firms, names that had stood for a century, simply evaporate. Lehman Brothers collapsed. Bear Stearns vanished into J.P. Morgan. The insurance giant AIG was on the brink of taking the entire global economy down with it. It was chaos. To prevent a complete meltdown of the system, the Federal Reserve did something that was, at the time, completely unprecedented. They turned on the printing presses like never before. They conjured roughly $4 trillion out of thin air to bail out the very banks that had caused the crisis. Now what happens when you inject that much new money into the system? Silver responded, and it responded with a vengeance. In November of 2008, as the dust was still settling, silver was trading for about $9 an ounce. Just 30 months later, by April 2011, it had skyrocketed to nearly $49. Let that sink in. A more than five-fold increase in under 3 years. It was an absolutely breathtaking rally. Of course, the moment the price went vertical, the critics came out in full force. "It's a bubble," they screamed. "It's just rampant speculation." They all predicted it would end in tears, just like the infamous silver spike of 1980, when the Hunt brothers tried to corner the market. And to be fair, they were right about one thing. The price did crash. From its peak near $50, silver tumbled all the way back down to around $14 by 2015. Anyone who chased the hype and bought at the top got absolutely crushed, losing about 70% of their investment. The mainstream media took a victory lap, declaring silver dead all over again. Another failed bubble, another cautionary tale. But here's what they completely missed. Here is the crucial lesson that Stage 2 taught us. It wasn't just about a temporary price spike. Stage 2 was the first real-world proof in the 21st century of a fundamental economic law. When central banks print staggering amounts of money, real tangible assets respond. When you dilute the value of a currency by creating trillions of new units, people instinctively seek refuge. They flee into things that can't be created with a keyboard. Things like gold, real estate, and yes, silver. And what we learned from 2008 to 2011 is that silver is one of the most sensitive, fastest responding assets on the planet to monetary inflation. It was a fire drill for what was to come. So we had Stage 1 from 1999, the quiet accumulation phase where silver went from $5 to around $9. Nobody noticed. Then we had Stage 2, the 2008 crisis response, where silver rocketed from $9 to $49 as the Fed printed $4 trillion. Everyone called it a bubble. Now think about what happened in 2020. The global economy shut down. How did governments and central banks respond? They didn't just print $4 trillion. They printed more than double that, and they did it in a fraction of the time. The Fed's balance sheet exploded from $4 trillion to nearly $9 trillion. If $4 trillion in new money sent silver from $9 to $49, what do you think more than double that amount of printing, combined with supply chain disruptions, soaring government debt, and a renewed global interest in hard assets, will do? We've seen the playbook. We saw the quiet accumulation in Stage 1. We saw the explosive reaction to money printing in Stage 2. The conditions that created that 5x move in 30 months haven't just reappeared, they've been amplified on a scale we've never seen before. This isn't about predicting the future with a crystal ball. It's about recognizing a pattern based on the simple, undeniable laws of supply and demand in a world of endless currency creation. The first stage was the whisper. The second stage was a loud warning shot. Many people believe we are now entering the third and most powerful stage of this silver story. The stage where the full impact of the last decade of monetary policy finally comes home to roost. The fundamentals are stronger than ever before. Industrial demand is soaring for use in solar panels, electric vehicles, and countless electronics. At the same time, investment demand is awakening as more and more people lose faith in paper currencies. It's a powerful combination. What you do with this information is up to you. But understanding this history, understanding these two critical stages, is essential for anyone trying to navigate the financial landscape we find ourselves in today. The story of silver over the last 2 decades isn't just about one commodity. It's a story about the changing nature of money itself. All right, let's talk about the silver market, because what's happening right now is bigger than most people realize. We're going to break it down into 5 stages, and stick with me, because stage 5 is the one that changes everything. Stage 1 was the quiet buildup from 2008 to 2011. After the financial crisis, central banks printed trillions. Silver, being real money, skyrocketed from around $9 to nearly $50. That was the market waking up. Stage 2 was the long, painful hangover from 2011 to 2019. Central banks managed to calm everyone down. Silver got boring. It bled out, falling all the way back to $15. Most people gave up and walked away. Then came stage 3 in March 2020. The world shut down. The global economy froze, and central banks responded with a tsunami of cash that made 2008 look like a warm-up. They printed around $18 trillion in just 2 years. The Fed alone printed more in that period than it had in the entire decade after 2008. And what did silver do? Exactly what it did in stage 2, but on fast forward. In March 2020, silver was about $12. By August, just 5 months later, it hit 30. That's a 2.5x move. But this time, something new and incredibly important happened. Retail investors showed up. The Wall Street bets crowd, the same people who made GameStop a household name, turned their focus to silver. They weren't just buying paper contracts. They were piling into physical metal. They bought up SLV, the largest silver ETF. They crashed the websites of major bullion dealers. For a brief moment, you literally couldn't buy physical silver anywhere. Premiums went insane. People were paying $40 for an ounce of silver that was trading in the high 20s on the paper market. The squeeze was on, and then it fizzled. The price pulled back. Not to the lows, but enough to shake out the weak hands. By late 2022, silver was back around $18. The media declared the silver squeeze a failure. Retail investors gave up. The story was over, except it wasn't. Stage 3 wasn't about a failed squeeze. It proved something far more profound. For the first time in history, regular people, retail investors, showed they had the collective buying power to seriously stress the global silver market and challenge the paper pricing system. That had never happened before. And that brings us to stage 4, which is happening right now. This is the stage almost nobody is talking about, but it's the most important one yet. Because this stage isn't driven by Reddit posts or short-term speculation. It's driven by raw, undeniable physical supply and demand. Let's look at the fundamentals. Global silver mine production actually peaked way back in 2016 at around 900 million ounces per year. Today, we're lucky to get about 830 million ounces. Production is falling. Why? A lot of silver is a byproduct of mining for other metals like copper, lead, and zinc. If it's not profitable to mine those, silver output drops. Plus, all the easy-to-get high-grade silver deposits have already been mined out. Meanwhile, demand is exploding. Industrial demand is at an all-time high, and it's not slowing down. Every solar panel needs silver. Every electric vehicle needs silver. All that 5G infrastructure uses silver. Your phone, your laptop, your TV, almost every piece of modern technology has silver in it. Industrial use alone is now consuming around 600 million ounces every single year. Then you have to add investment demand on top of that. Silver ETFs are holding around 700 million ounces in their vaults. That metal is just sitting there, off the market, and it's not coming back unless prices go way, way higher. Countries like India and China are importing record amounts for jewelry and investment. Even some central banks are quietly adding silver to their reserves. Just do the simple math. We're mining about 830 million ounces a year. Industry is using 600 million of that, and that doesn't even count all the people buying coins and bars or the ETFs and national demand. We have been in a supply deficit for years. We are consuming more silver than we produce, and we've been filling the gap by draining the above-ground stockpiles. Those stockpiles are getting dangerously low. The COMEX, the exchange where silver futures are traded, has only about 250 million ounces in its registered inventory. That's the metal actually available for delivery. That sounds like a lot until you realize that industrial demand alone could wipe that out in a matter of months. Stage 4 is the setup. This is the stage where the fundamentals become impossible to ignore. It's where the paper market, which has artificially suppressed the silver price for decades, starts to crack under the pressure of physical reality. The gap between the paper price and what it costs to get actual physical silver in your hand is starting to widen. Right now, silver is around $31 an ounce. Yes, it's up from the 2020 lows, but think about this. It's still way below its 1980 high of $50. It's still below its 2011 high of around $49. Most people see this and think silver is just stuck, that it's going nowhere. They are completely missing the point. They are looking in the rearview mirror, but the biggest move is still ahead. Because Stage 5 is coming. And it's going to look nothing like anything we have ever seen before. Now, whenever silver starts to rally, you hear the same old story. Remember the Hunt brothers? This is just another bubble waiting to pop. People use the 1980 spike as a warning, but almost nobody understands what really happened back then or why today is completely different. In the 1970s, two Texas oil billionaires, Nelson Bunker Hunt and William Herbert Hunt, decided to protect their fortune from runaway inflation. The dollar had been disconnected from gold, and oil prices were spiking. Their logic was simple. Paper money was being destroyed, so they would buy real money, silver. And they didn't just mess around with paper futures. They took delivery. They bought physical silver. By 1979, they had accumulated about 100 million ounces of physical metal, which was roughly half of all the deliverable silver in the entire United States. The price reaction was explosive. Silver went from $6 an ounce in early 1979 to $50 by January 1980. An eightfold increase in about a year. Regulators and the establishment panicked, so they changed the rules. The exchange introduced Silver Rule 7, which banned anyone from opening new long positions. You could only sell, you couldn't buy. At the same time, they jacked up the margin requirements, making it incredibly expensive to hold a leveraged position. The Fed pushed interest rates to 20%. The Hunts were trapped. They were forced to liquidate their massive position to meet margin calls. The silver price collapsed, crashing from $50 down to $10 in just 8 weeks. It was one of the fastest commodity crashes in history. The Hunts lost billions and eventually went bankrupt. For the next 40 years, that story was used as the ultimate boogeyman to scare anyone away from silver. But here's what everyone misses. The Hunt brothers' squeeze was a concentrated, highly leveraged bet made by just two billionaires using the futures market. When the regulators changed the rules on them, the game was over. Stage 5 will be nothing like that. It won't be two billionaires. It will be millions of people all over the world. It won't be a leveraged futures play. It will be a global scramble for physical metal. It won't be something the regulators can stop by changing a rule on an exchange. How do you stop millions of people in 100 different countries from buying a 1-ounce silver coin? You can't. Stage 5 is the end game. It's when the industrial users, the manufacturers, the tech giants, realize the stockpiles are gone and they can't get the physical silver they need to build their products. It's when the paper market finally breaks and the price of a contract on a screen becomes disconnected from the price of real metal in your hand. We are not there yet. But we are in Stage 4, the final setup. The fundamentals are locked in. The physical deficit is real and it's growing. This isn't a story about a short squeeze anymore. This is a story about a long-term global supply crisis. Ever wonder what a real modern-day market corner looks like? Forget the old stories of two billionaires secretly buying up all the supply. Stage 5 of the silver squeeze is something entirely different, something far bigger and more unstoppable. We're talking about millions of retail investors, all connected, all sharing information in real time. We're talking about hundreds of institutional funds, all chasing the same finite resource. And most importantly, we're talking about massive industrial users, from tech giants to green energy companies, scrambling to secure the physical silver they absolutely need to keep their production lines running. This isn't a game of paper contracts anymore. This is about a real structural shortage of physical silver, a shortage that can't be fixed by printing more paper derivatives or changing a few rules on a futures exchange. To truly understand why this time is different, we need to look back at the last major silver squeeze in 1980. Back then, when the Hunt brothers drove the price to $50 an ounce, the world was swimming in silver. Global inventories were massive. Governments held billions of ounces in strategic stockpiles. The U.S. alone had a huge reserve built up since World War II. Countries like India and China had vast accumulated reserves from centuries of history. So when the price spiked, a flood of metal hit the market. Governments saw an opportunity and sold off their holdings. People all over the world started melting down their family silverware, their old coins, their antique tea sets. A wave of scrap metal flooded the refineries. The market was overwhelmed with supply and the squeeze broke. The price came crashing down. Now, fast forward to today. The landscape is completely, fundamentally different. Let's look at the supply side first. That massive U.S. strategic stockpile, it's gone. It was sold off completely, decades ago. What about India? That vast store of cultural silver has been transformed. It's now in jewelry, religious idols, and decorative items, forms that are deeply personal and highly unlikely to be sold as scrap unless prices reach truly astronomical levels. And China? China has done a complete 180. It's gone from being a silver exporter to one of the world's largest importers. Its above-ground stocks are declining, just like everyone else's. The easy-to-access emergency reserves of 1980 simply do not exist today. But the biggest change is on the demand side. In 1980, industrial demand for silver was significant, but it wasn't the bedrock of the global economy. Today, it's non-negotiable. You cannot make solar panels without silver. It's the most conductive element on the planet, and it's essential for converting sunlight into electricity. You cannot build electric vehicles without silver. They use it in everything from battery connections to window defrosters, and you can't roll out 5G networks without silver. It's a critical component in the high-frequency electronics that make the network function. And here's the crucial part. For these massive multi-trillion-dollar industries, there is no scalable substitute for silver. They've looked, they've tried. Nothing else works as well or as cost-effectively. So when the silver price spikes this time, these industrial giants can't just walk away and wait for it to cool down. They have to keep buying. If they stop, their entire supply chain grinds to a halt. Production stops. Product launches are delayed. Multi-billion-dollar projects are put on hold. They will pay whatever it takes to secure the physical metal they need. Now let's add another massive layer that didn't exist in 1980, exchange-traded funds, or ETFs. Today, just one ETF, the SLV, holds around 500 million ounces of silver. The Sprott Physical Silver Trust, or PSLV, holds another 150 million ounces. When you add up all the other silver funds around the world, you get to a staggering total of roughly 700 million ounces. That's a colossal amount of metal that has been effectively taken off the market and locked away in vaults. This silver isn't being used for industry or jewelry. It's being held for investment, and it's not likely to be sold unless prices truly explode to multiples of where they are today. Then there's the retail investor. In 1980, if you wanted to buy silver, you had to find a local coin shop or a bullion dealer. Information was slow and came from newspapers or monthly magazines. Today, we are globally connected. One viral post on social media, one powerful video, one major narrative shift can trigger coordinated buying from millions of people across dozens of countries in an instant. This isn't a couple of billionaires in a smoke-filled room. This is a decentralized global movement. You can't just change the rules at the exchange and force millions of individual buyers around the world to sell their physical holdings. You can't regulate away a grassroots demand for real, tangible assets. So, how is the price of silver even determined right now? It's mostly set in the paper market, on exchanges like the COMEX in New York. This happens through the trading of futures contracts, which are essentially bets on the future price of silver. Here's the catch. The overwhelming majority of these contracts are settled in cash. Very few people actually demand delivery of the physical metal. The paper market is estimated to be over 100 times larger than the actual physical market. This system works, but only as long as there's enough physical metal in the background to satisfy the small percentage of contracts that do stand for delivery. It's a system based on confidence. But what happens when that confidence shatters? What happens when those industrial buyers, unable to get supply from their normal channels, turn to the COMEX and start demanding delivery on their futures contracts, not in the thousands of ounces, but in the millions? What happens when ETFs try to buy hundreds of millions of ounces to meet investor demand, only to discover that only a tiny fraction of that amount is actually available for purchase on the open market? What happens when the relentless tide of retail and industrial demand collides with dwindling global inventories? That's when the paper price and the physical price completely diverge. We actually got a small preview of this back in 2020 and 2021. The paper price on the COMEX was hovering around $25 an ounce. But if you tried to buy a physical silver coin or bar from a dealer, you were being charged $35 or more. That's a 40% premium, a huge gap between the paper price and the price of the real thing, in what was supposedly a normal functioning market. Eventually, that gap narrowed, but only because industrial demand slowed down temporarily due to global shutdowns, and some spare inventory was coaxed back into the system. But that was a warning shot. Next time, that spare inventory won't be there. The stockpiles are gone, the industrial demand is structural, and the investment demand is bigger than ever. Next time, that gap between the paper price and the physical price might not close. And that is stage 5. Stage 5 is when the illusion breaks. It's when paper silver trades at one price on a computer screen, but physical silver, the real metal that you can hold in your hand, trades at a much, much higher price in the real world. It's the moment the market realizes that a paper promise is not the same as a physical ounce. It's when the futures market, which is supposed to reflect reality, completely detaches from it. And for those who understand what's happening, it could be one of the most significant financial events of our lifetime. Have you ever wondered what the world would look like if silver became as precious as gold? Not just as an investment, but as a critical strategic resource that nations scramble to secure. We're talking about a scenario experts are calling Stage 5, and it's not a question of if, but when. So what is Stage 5? It's a future where silver prices aren't just a little higher, they're at sustained, much higher levels. We could be looking at triple-digit prices per ounce. Think about that for a moment. What happens when a metal so fundamental to our modern world becomes that expensive? Well, for starters, industrial users would face a massive challenge. Silver is everywhere. It's in your phone, your laptop, your car, and in the solar panels that power our green energy transition. A price explosion would force companies to completely redesign their products. They'd have to rethink how they use silver or find alternatives, which for many applications simply don't exist with the same efficiency. This isn't just a minor tweak, it's a complete industrial overhaul. Beyond industry, governments and major institutions would start treating silver very differently. Right now, it's often viewed as just another commodity traded on financial markets. In Stage 5, it would be elevated to the status of a strategic metal. Nations would begin to stockpile it, just like they do with oil reserves or gold. Access to silver would become a matter of economic and even national security. The global scramble for physical silver would be unlike anything we've ever seen before. Now you might be thinking, haven't we seen this before? What about the Hunt brothers in 1980? That's a great question, and the distinction is crucial. The 1980 price spike was a speculative bubble. It was driven by leverage, futures contracts, and a concentrated effort by the Hunt brothers to corner the market. When regulators stepped in and changed the rules, the whole thing collapsed. The shortage they created was an artificial one on paper. Once their financial grip was broken, the price of silver crashed right back down to single digits. Stage 5 is fundamentally different. This isn't about a trading gimmick or a speculative frenzy on Wall Street. The coming shortage is rooted in the physical world, in simple, undeniable mathematics. For years, we have been consuming more silver than we mine and produce. Think about it. Every year, the world uses up more silver than it pulls out of the ground. Where does the difference come from? It comes from inventories, stockpiles, and reserves that have been built up over decades. But those stockpiles are not infinite. They are shrinking year after year, day after day. You can see it in the data from the COMEX, from the London Bullion Market Association. The inventories are being drawn down at an accelerating rate. The math doesn't lie. We are on a collision course with reality. Stage 5 is simply the name for the moment when the math finally catches up with the market. It is the point where there's no more spare inventory to fill the gap between supply and demand. It's the moment when an industrial user goes to buy a 1,000-ounce bar and is told, "Sorry, we don't have any." When that happens, the price discovery mechanism will break, and the true value of physical silver will be unleashed. This isn't a prediction of a sudden, one-day event. It will likely be a process. But once it starts, the repricing could be swift and dramatic. The paper market that currently suppresses the price will become irrelevant when the physical metal is gone. So this brings us to the two most important questions you should be asking yourself. First, when does Stage 5 begin? No one has a crystal ball, but by looking at the inventory drawdown rates, we know it's getting closer every single day. The signs are all there for those who are willing to look. And the second, more personal question is, will you be positioned before it does? When this shift happens, it will create a massive transfer of wealth. Those who understood the simple math and prepared will be on the right side of that transfer. This isn't about getting rich quick. It's about understanding a fundamental market imbalance and protecting your wealth from what's coming. The train is leaving the station. The only question is whether you'll be on it. Thanks for watching, and if you found this breakdown insightful, make sure to like, subscribe, and hit the notification bell so you don't miss our next video. See you next time.